India was the emerging market darling for 3 straight years, but in 2025, that story has flipped hard. Indian stocks have lagged emerging market peers by the widest margin in over 30 years. Foreign money is heading out, the rupee is sliding, and global investors are chasing new themes. So what changed? And why is India suddenly looking less irresistible? Let's break it down in markets this week. First, let's look at the gap. The MSCI India Index is up just 2.5% in dollar terms this year, and compare it with the broader MSCI Emerging Markets Index, which is up nearly 28%. Now that's a massive divergence, the widest since 1993. And foreign investors, over $16 billion has left Indian markets in 2025, one of the biggest pullouts on record. So the obvious question is, where did that money go? A lot of it is rotating into tech-heavy Asian markets, think China and South Korea, where investors see a clean, obvious theme: AI-linked winners. Now, India doesn't have an equally clear AI-led market leadership story right now. So for global funds, India becomes the place you trim to fund what's rallying. Some investors have even described India this year as a funding trade: book profits here, chase momentum elsewhere. But this isn't only about AI envy. India has its own pressure points. 3 things have hit sentiment at once. First, trade uncertainty, especially around a US-India deal. Second, earnings downgrades. Corporate expectations have been cut through the year. Third, positioning. India was priced as a premium market, and when growth looks less clean, premiums get questioned. As a result, lower earnings visibility, weaker foreign appetite, and a gradual derating. And then there is the currency hit. The rupee has weakened past 90 to the dollar, down nearly 5% this year, making it the worst performing major Asian currency in 2025. For foreign investors, that is brutal. Even if stocks are up a bit, currency losses can wipe it out. So the trade is simple. Why take India risk if FX is hurting returns? Now, another pressure on the market is the RBI's interest rate stance. With inflation cooling but rates still high, real rates stay elevated, and that can weigh on demand, borrowing, and profit expectations. Markets don't fall just on bad news, they fall when the next quarter looks foggy. And yet, the market hasn't cracked the way foreign flows suggest it should. Why? Because retail money is holding the line. SIP inflows keep coming, cushioning the sell-off, keeping the Nifty close to highs. So, is the worst over? Maybe. Big names like Goldman Sachs and HSBC are betting on reforms and an earnings bottom. But the next leg depends on 3 things: earnings recovery, rupee stability, and clarity on trade and global positioning. Because India's long-term story isn't gone, it's just being stress-tested in real time. That's it for this market special. For crisp, noise-free market explainers, stay with Business Standard.